Okay, Professor Jim Schultz here from my Finance 512 class. I wanted to bring you guys in for a live trading session with me here on July 7th. It's Tuesday, and today, the last couple days, have been outstanding trading days with all the activity from Greece, and just all the market movement presents a lot of opportunity. And so I put a few trades on this morning in my live account, and I wanted to go ahead and walk through those trades with you guys here in my paper money account, which with the markets down a little bit is absolutely flourishing. And so that is obviously a good thing. So let's go ahead and get started. The first trade I wanted to make today was I wanted to get long oil. So USO is an oil ETF. So generally speaking, the cleanest way to get long oil would be using the futures market, which is what I'm going to do here in a second. But I also want to use the options market, and I don't want to use options on futures, mainly because we haven't talked about that in class. And so I'm just going to use the straight up options on this USO ETF. And some people don't like to trade futures, or they can't trade futures for whatever reason. And so understanding how to use these ETFs is obviously very beneficial. So I want to get long USO, and the reason why I want to get long USO, if we look at a chart, is because it has just gotten completely beaten up these last few days. And I personally love to step in and buy things when they've gotten totally beaten up. Just like I love to step in and sell things when they've had tremendous price runs. I like to be a little bit contrarian in my thinking, and I don't know if it gives me an advantage or not. But I'm still standing, so it probably says a little something. So let's go ahead and get long USO using the August options. Now I want to use the August options mainly because I like the 45 days to expiration right here. Now this is straight up from Tasty Trade. I told you guys about Tasty Trade and the guys over there. They are unbelievable, and I have to give those guys all the credit when it comes to the optimal days to expiration in terms of entering trades. They've done a tremendous amount of research that I have looked at, and I completely agree with. That 45 days to expiration gives you time to manage the trade, it gives you duration for the trade to work in your favor, and it gives you a nice pace of time decay if you are an options seller, which is something that we talked about in class. And so I'm going to go ahead and I already put this trade on. So I actually put this trade on right before the video started. And so I actually got long. I see that here because I see that I got long USO by selling these 17 puts. I was looking at this right before the video started, and I must have went ahead and already gotten long oil. So I can show you guys what I just did 2 minutes ago in this account. So I sold the 17 puts, which as you guys know is a long position. So I did a 10 lot in the 17 puts, and then I also used the futures market to get long some crude oil by buying 5 contracts of /CL, which is the base symbol for crude oil. I like options obviously because you have a statistical advantage. I like futures because you're able to use a lot of leverage to make a straight up 50-50 bet on where you think the price is going next. And I think the price of oil is going higher. So we will just, so we'll see. Next. The next thing I want to do is I want to look at Tesla. Now, I kind of have a personal grudge against Tesla. Not because I don't like their products. I think Elon Musk is a genius, and I think they have an amazing product. I just have a personal grudge against Tesla because the stock just refuses to go down. For the last 47,000 days in a row, Tesla has just gone higher. And then today we finally see a nice downtick in Tesla, dropping about $15, which is terrific. Because I'm short Tesla in my live account, but I want to show you guys how to do a different trade. I'm going to put on a strangle in Tesla here in the paper money account. So you guys might remember what is a strangle. A strangle is where you sell an out-of-the-money put and you sell an out-of-the-money call, and your hope is that the stock stays within that range before expiration, and then you're able to collect both premiums as they both expire out of the money. And so what I'm going to do is, if you wanted to, and you guys should do this because you're learning this stuff for the first time, but you can go down to the option statistics. You have implied volatility of 41.44. You have days to expiration of 45. You have the current stock price. I would go ahead and calculate the expected move to figure out, what the market is anticipating for this stock. I'm not going to do that right now because I've been doing this for a while, and I'm very comfortable using the Thinkorswim software. And I know that if I want to be at about the 1 standard deviation mark on both sides, I'm going to want to be at about the 84% probability of out of the money. So I'm going to sell this 220 put, which is 86%. So I'm going to click sell on the bid, and then I'm going to go down on the call side, and I'm going to go ahead and sell this 300 call. That's about 83%. So I'm going to hold down control. I'm going to sell that guy too. You see Thinkorswim knows that this is a strangle. I'm only going to do, I only have $3,000 left in buying power, so I hope that I can at least do a 1 lot. So I'm going to pick up $6.40. The buying power effect is only $2,600, and that's because this is an interesting point. So you see my maximum loss is infinite, right? Because it's true, I'm selling naked options. But Thinkorswim knows, and brokers know, that that's a theoretical thing. You're not going to lose an infinite amount of money. It's just the real risk gets priced at about the 2 standard deviation mark. So the real risk, according to Thinkorswim, is that this thing has a 2 standard deviation move. So they're going to take out the buying power that's associated with that 2 standard deviation move. So I'm going to go ahead and send this guy. Yeah, that's fine. That just has to do with overnight margin and whatnot. That's not a big deal. Tesla's not a super liquid stock, so it's very possible that I'm gonna have to penny this down until I get filled. I'll go down a couple cents. And again, Tesla's not a super liquid stock. You could wait if you wanted to. For the purposes of this video, though, I just kind of want to get filled. So let's, oh, there we go. All right, so we're filled at 635. Okay, so now what I'm going to do, which is what I kind of told you guys about in class last time, is now that I have this guy in, I'm going to do this for my oil trade too, but I kind of want to wrap this video up. I sold this strangle for 635. I'm going to target about 50% of max profit. So I'm going to go ahead and, oh, it's down here. So I'm going to go down to Tesla, which is right here. And I'm going to highlight both of those. And I'm going to do create closing order. And I'm going to make this a GTC order. And I want to get about 50% of 635, which is going to be about 317 approximately. So I'm just going to put that guy in there, and I'm just going to leave it. That way it's out there. So if Tesla does indeed shrink, then I can go ahead and get that order routed to the market maker. I don't have to worry about it anymore. As you can see, I have a lot of other things going on, and so all right. So I hope that was helpful for you guys. Those were a couple of trades I did earlier. I wanted to walk you through that. Another trade I did earlier was I got short Disney because it's been on such a tremendous run. I'm not going to go through that for the video because I kind of wanted to get this thing at about 10 minutes, and we're at about 10 minutes now. And so I hope this was helpful for you guys. I'll get this up on the website for you guys and email it out to you guys as soon as I can. And I'll see you guys next time.